You've been grinding at a side income, freelance work, consulting, maybe a small business you built on weekends, and you've been quietly using that income to fund your retirement catch-up. Smart move. But there's a tax break woven into that strategy that most people don't even know they're using. And it's scheduled to disappear on January 1, 2027. The Tax Cuts and Jobs Act of 2017 created the Section 199A deduction, a 20% deduction on qualified business income for pass-through entities and self-employed workers. The IRS estimated that roughly 17 million taxpayers claimed it in the first full year it was available. 17 million. And unless Congress extends it, which, as of right now, is not guaranteed, that deduction sunsets completely after December 31, 2026. That gives you one tax year, 2026, to use it at full strength. What that means for your retirement math and what the right move looks like before that window closes is worth sitting down and thinking through carefully. Let me tell you where this deduction came from, because the history matters more than most people realize. When Congress passed the Tax Cuts and Jobs Act in December 2017, the big headline was the corporate tax rate dropping from 35% to 21% permanent. But if you weren't a C corporation, you got a different kind of relief. Section 199A was designed to give pass-through businesses, sole proprietors, S-corp, partnerships, LLCs taxed as pass-throughs a way to compete with the new lower corporate rate. The logic was straightforward. If big corporations were getting a permanent cut, small business owners deserved something too. So Congress created this 20% deduction on net qualified business income. Here's the catch that almost nobody mentions: the corporate rate cut was made permanent. The pass-through deduction was not. It has a hard expiration date baked right into the law, December 31, 2026. That asymmetry is honestly one of the more quietly unfair things I've seen come out of tax legislation in a long time. The people who needed it most, the self-employed, the freelancers, the late career consultants trying to claw back some retirement savings, got the version with an expiration date. So what does Section 199A actually do? If you have qualified business income, that's net profit from a pass-through business, you can deduct 20% of it from your taxable income before calculating your federal income tax. Not a credit, a deduction. And for most people in the 22% or 24% bracket, that's real money. Say you're 55, you do freelance project management on the side, and you net $40,000 in self-employment income after expenses this year. Under Section 199A, you can potentially deduct $8,000 of that, 20% of $40,000, from your taxable income. At a 22% marginal rate, that's roughly $1,760 back in your pocket. Not enormous by itself. But stack that across a few years, and it adds up to a meaningful chunk of retirement savings. Now the IRS does impose income thresholds that change how this works depending on your situation. For 2025, the phase-in range starts at $197,300 for single filers and $394,600 for married filing jointly. Below those thresholds, most people with a straightforward service business can take the full deduction without complication. Above them, the rules get more complex. There are limitations based on W-2 wages your business pays and the type of business you're in. Certain service businesses, what the IRS calls specified service trades or businesses, think lawyers, accountants, consultants, financial advisors, face stricter phase-outs at higher income levels. Your filing status and income level genuinely change the math here, so this isn't a one-size answer. Here's where it connects directly to your retirement strategy, and this is the part I think most people miss completely. Your self-employment retirement contributions, whether that's a SEP IRA, a simple IRA, or a solo 401k, reduce your net self-employment income, which is the base that the Section 199A deduction is calculated on. At first glance, that sounds like a problem. But it isn't, because those contributions also reduce your overall adjusted gross income, which can keep you under the Section 199A income thresholds I just mentioned, which in turn allows you to claim the full deduction rather than a reduced one. There's a feedback loop here that actually works in your favor if you plan it right. Walk through the numbers with me. Same freelancer, 55 years old, $40,000 net self-employment income. In 2026, the solo 401k employee contribution limit is $23,500. And if you're 50 or older, you get a $7,500 catch-up contribution on top of that, so $31,000 total in employee deferrals. You can also make an employer contribution of up to 25% of your net self-employment compensation on top of that. If this person contributes $20,000 to a solo 401k, their qualified business income for Section 199A purposes doesn't drop to zero. The calculation is slightly more nuanced than a simple subtraction, but the contribution significantly reduces their taxable income while also potentially keeping them squarely inside the full deduction threshold. The retirement contribution and the 199A deduction are stacking, not canceling. That double stack is the opportunity that disappears after 2026. And I want to spend a minute on the edge case that trips people up most often, because I've seen this cause real damage. A lot of people assume that if they do any kind of professional service work, coaching, consulting, writing, design, they automatically qualify as a specified service, trade, or business and therefore might lose the deduction at higher incomes. That's not always true. The IRS definition of a specified service, trade, or business under Section 199A is more narrow than most people expect. Engineering and architecture were explicitly carved out of the restricted category. Many trades, electricians, plumbers, construction contractors, are not restricted at all. Even within the service categories, the IRS looks at whether the business's reputation or skill of specific employees is the main asset. If you're a freelance writer or a web developer and your income is below the threshold, there's a strong argument you're outside the most restricted category. The IRS guidance here is in Treasury Regulation 1.199A5, and it's detailed. My point isn't to give you a legal conclusion. Your situation depends on your specific business activity, but it is to say, don't assume you're disqualified before you look carefully or before you talk to someone who knows this area. There's another wrinkle worth knowing about. Some people who have both W-2 employment income and self-employment side income assume the 199A deduction only applies to pure self-employment income. That's correct. You can't deduct 20% of your W-2 wages. But your W-2 income does count toward the overall income threshold calculation that determines whether you phase out. So if you earn $90,000 at your day job and $30,000 from freelance work, your combined income is what the IRS looks at against those thresholds. For most people in that boat, you're probably still well under the phase-out range for 2026, and the full deduction on your $30,000 net business income is available. But if you had a particularly good year, a big consulting contract, a business sale, that's when you want to run the numbers before the year closes, not after. What most people get wrong about all of this is the framing. They think of Section 199A as a nice-to-have, something their accountant handles. My take is that if you're 50 or older, have any self-employment income, and are trying to close a retirement gap, this deduction is a core part of your strategy, not a footnote. The combination of the 199A deduction, catch-up contributions under Section 402G, and the employer contribution rules for solo 401(k)s creates a compounding tax efficiency that you genuinely cannot replicate any other way. And after 2026, one of those three legs is gone. I work with people 50 and over who are planning their retirement. And the pattern I keep seeing is that people treat 2026 like a normal year. It isn't. If there's ever a year to maximize your self-employment retirement contributions, to open that solo 401k if you haven't yet, to run a real projection with someone who understands both the retirement contribution rules and Section 199A, it's this one. The solo 401k has to be established by December 31st of the tax year you want to use it. You can't open it in April during tax season and apply it retroactively to 2026. That's a hard deadline. The SEP-IRA has more flexibility. You can open and fund it up to your tax filing deadline, including extensions. But the 199A deduction itself requires that the income was earned in 2026. Now, could Congress extend Section 199A? Yes, it's possible. There's been some legislative discussion about it, and there are members of both parties who have expressed interest in making it permanent. But I'd strongly recommend you don't plan around Congress will fix it. That's not a strategy. Plan as if December 31, 2026 is real, because right now it is. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this is something that affects your situation, the next step isn't complicated. Talk to a CPA or a fee-only fiduciary who understands pass-through taxation and retirement accounts, ideally before the middle of 2026, when you still have time to adjust how much you're earning or contributing. If you don't have a solo 401k yet and you have self-employment income, the clock on establishing one for 2026 is ticking. If this channel has been useful to you, subscribing helps. It's the best way to make sure you don't miss something that matters. And if there's a specific retirement or tax question you'd like me to dig into, a Social Security timing question, something about Roth conversions, whatever's sitting on your mind, drop it in the comments. I read them and I build videos around what people are actually wrestling with. Subscribe so you don't miss the next one.